Hello again, my friends. Welcome to the show. Thank you for joining us on The Conversation. I'm Ryan Campbell. I'm here joined by friend Justin Myers. Justin, you're the owner of Caldwell Insurance in Tuolumne County. And we had a lengthy discussion at the Board of Supervisors meeting last week about the state of fire insurance in Tuolumne County and what's going on here. And you agreed to come and talk a little more in depth about it, and I really appreciate it. Welcome.
Thanks, Ryan. Glad to be here, and hopefully today we'll be able to answer some of your questions and shed some more insight on this challenging and crazy market that we're all trying to navigate.
It is a crazy market. Can you explain what is crazy about it? What is going on? Why is it so difficult for people to keep and maintain and acquire insurance? Just kind of, for somebody that's not familiar, how would you describe the homeowners insurance situation in Tuolumne County?
We're at that point where we're at an insurance crisis. Here in Tuolumne County locally, the state's starting to feel it. That's more of a recent trend that's happened. Prior to the Rim fire in California having these historical large fires, the property insurance rate, the rates that we were paying in Tuolumne County here locally, if you had this, we're living in the same protection class in Tuolumne County as, let's say, the city of Modesto, the rates were the exact same. Since that time, that's changed.
Okay, and that's because we're perceived to have a lot more risk. It's not that there has been a destructive fire in Tuolumne County that's destroyed many homes. It's that there's a possibility of it.
Yeah.
Is that what the insurance industry is looking at?
100%, right? It's an insurance company is, it's based on actuarials and risk.
Now, what is an actuarial? Because I have an idea of what I think it is, but you tell me, what is an actuarial?
To keep it very simple, for every dollar that an insurance company takes in, right, they want to make sure that they're not paying out more than that dollar. Okay. So an insurance company is going to look at a risk. They're going to look at historical data and the amount of property that they're insuring. It's oftentimes referred to as like the total insured value. So in the event of a catastrophic loss, we're going to pay out X number of dollars. Yeah. So they take that total risk that they have on their portfolio and need to make sure they're taking in enough premium should a catastrophic fire or a catastrophic event happen. Mm-hmm. And so what has happened is, 10 years ago when we weren't having these large historical fires happen so often or so big, insurance companies were rating homes that in an event where, you had a house fire and it maybe spread to the neighborhood and the insurance company would be paying out, on a large event, maybe 5 or 6 homes got lost, right, in a neighborhood. As opposed to recently with these large historical fires, they're paying out for hundreds or if not thousands of homes that are being destroyed. So that number is way different today than it was before. Yeah. And that's really changed the risk and the exposure and kind of driving the rate.
Okay, and that's an interesting issue because I'll play devil's advocate here, okay? Yeah. The way it's perceived with a lot of property owners in Tuolumne County that have been denied insurance, or their insurance rates are increasing, or they're I'll say forced to use the FAIR plan because it's very expensive. What it feels like is that there's this perception that Tuolumne County is a higher risk and that fires are more likely to happen here than somewhere else. And there have been other fires throughout the state. And so this is if I own an insurance company, this is my opportunity to jack those rates up and, kind of squeeze these communities and get more money out of them because there's this perception that there's more risk. And understanding whether or not that risk is truly at the level that the insurance industry seems to think it is, I think that's where a lot of the conflict is. Sure. Because for me, I don't see that the risk is any higher than it was during the Rim fire. If anything, we've taken many steps as a community to make that risk much less. So why then do the insurance rates continue to increase?
Sure. So I think going back to once again, we're kind of using like the rim fire, right, as just a point in time. Prior to that, once again, we were paying the exact same rate up here. If you had a fire hydrant, within 1,000 feet, lived within 5 miles of a fire station, as you did in the city of Modesto.
Yeah.
And I think we can both agree that, a house in Twainhart that's surrounded by trees and brush, right, is a different risk than that in the middle of Modesto. And so these fires started occurring at a more frequent, large and burning much higher levels of acreage after the rim fire. And so the insurance company said, oh, wait a second here, if this is potentially a new trend where we're going to see these larger fires that are burning hundreds of thousands of acres, we need to take a look at our risk in our portfolio and where we're insured, because at the end of the day, they got to pay out, right? Insurance is a contract. So what had happened there is certain companies started pulling out of the market. It was very few of them, but certain of them kind of were on the front end of this. And then those preceding years, we look at like the Tubbs fire in Napa and Sonoma, and when you get a wind-driven fire, that's crossing the freeway, 6 lanes of freeway, and it's interesting because I follow that. I took a close eye on that fire, and when you have a fire that's able to cross that much freeway and then burn down a concrete tilt-up, because what happens is, right, with these fires, they're wind-driven with the embers, right? So it just takes 1 or 2 embers getting inside. So when you have a concrete tilt-up getting burned from the inside out, it like changed the game in the insurance industry, and them going, oh my goodness. So those handful of carriers that pulled out prior to these large fires, their decision was confirmed.
So explain what's your role in, so you don't actually sell the insurance. You are you connect people. If I'm buying a home in the community, you connect me with an insurance provider. That's kind of the role that
Sure.
So you kind of see it from both sides. From
We do.
the insurance side and then from the property owner's side, because you're the one making that connection. How are you finding that the availability of insurance is impacting the way people make choices when they want to purchase a home?
Right. Today the market's very, very difficult, and we, as you mentioned, we act as a broker or an agent. So we represent some insurance companies, or a handful of insurance companies, which many of them are shrinking because they're pulling out of the entire state.
Wow.
As of recent. And then at the same time, we work with the consumer and the homeowners. We also do a lot of commercial building insurance. And our job is to go to the marketplace, find the best level of coverage for the needs of our customer, and then match them with an insurance company. Yeah. And when it comes down to the marketplace, I can say that 2 years ago, we probably had close to about anywhere from 5 to 10, because the market's constantly fluctuating, but 5 to 10 companies to go to on the homeowner side.
Yeah.
And today we're down to 2, and that doesn't include the California Fair Plan. The California Fair Plan would be the third one. That's obviously the last option we want to
What are the 2 that are still operating?
The 2 that we're still currently riding with are with Safeco and Travelers.
Okay.
They're not riding in high brush areas, so what we're having to do is, if you are in a brush area, which is most of Tuolumne County currently.
I was going to say, what area in Tuolumne County isn't a high brush area?
Right. We're turning to them to write the companion policy, which is referred to as a difference in conditions policy, and that kind of goes alongside the California Fair Plan.
Yeah. So, speaking on California Fair Plan, can you explain what that is?
Sure. So the California Fair Plan, it was developed, or it came about in the late 60s after the riots in LA. And the California Fair Plan is required and mandated by the state of California. A misconception often is that it's a state-run plan. It's actually not a state-run plan. It's, once again, state mandated and required.
Okay.
But it's actually a pool, a true insurance pool that is made up of all the consumers in California that need to utilize that.
Yeah.
And on any preferred or standard insurance company, so if you have a State Farm policy, let's say, there's a small percentage of that State Farm policy that you pay a tax on that actually goes into the California State Plan, California Fair Plan, to help run and operate that. It's a very small percentage. So it truly is a pool that a lot of consumers are having to go to. Now, it was designed, as I mentioned, in the late 60s after the riots, and it was utilized for those properties that were really hard to place, and either had a very bad loss history, or they weren't upkept, and no insurance company would want them, right? Because the risk was just too high.
That's kind of interesting, the history on that, because I honestly didn't know that. So it's something equivalent to there were these terrible riots, homes burned, homes were damaged. There wasn't a lot of incentive or desire among insurance companies to go back into those neighborhoods. That's kind of analogous to what's happening here. Obviously, very different situation than riots, but I guess it's just an aversion to areas where there's mass destructive events. That's kind of what it is.
Mass destructive events, high risk. We're probably writing 70 to 80% of our policies today with a California Fair Plan, where 5 years ago it was less than 2%.
Wow.
Less than 1%.
That's amazing. And can you explain why is it so much more expensive? Because, like you said, there's this perception that it's a state-run insurance plan, but obviously it's not. It's run by a assemblage of private insurers. But generally, there's this perception that if the state has their stamp on it, that it would be subsidized. It should be cheaper, but it's absolutely not cheaper. What is driving that? Is it just the fact that, well, you have to be on the fair plan, so obviously you're high risk, so we're going to have your rates higher?
Yeah.
How does that work?
Great questions. In any insurance company, whether it's health insurance, life insurance, we're specifically today talking about property insurance, right? The best portfolio would be to spread your risk equally among maybe some difficult risks, some high exposed risks, but also some great ones. Well, when you look at how the California plan is being utilized, well, now what's happened is we've taken all these high risk homes in these high brush areas and put them into one pool. So in the event of a catastrophic loss where hundreds or thousands of homes are being lost, they need to make sure that they have the reserves in that California Fair Plan to pay out those policyholders. And the interesting thing is, with a standard insurance company, a lot of times they're mutual companies or they're operated by stockholders, so profits are getting distributed right to stockholders.
Yeah.
Well, in the California Fair Plan, there's no stockholders. It's not a mutual company. It's a true risk pool. So any of the losses or gains in that stay in that California Fair Plan.
Oh, okay. So it has to completely be self-sustained and pay for itself.
Correct.
I see.
And that's what's driving, we're seeing these rates are constantly going up, and they're one of the most expensive plans out there, of course.
Yeah.
Because they need to make sure that in their reserves, should a catastrophic fire occur, they can pay those out.
Yeah.
And it doesn't help when you're only taking in high risk.
Yeah.
Right?
Yeah. Well, and it's funny. It seems like, so we're in California, right? Mm-hmm. Every 10 years, there's some kind of disaster that becomes the disaster. We had earthquakes in the 90s. We had, like you said, we've had riots in the past. We've had flooding. Is a major issue in California. We've got it all. Okay, and it seems like that becomes a big focus in the insurance industry. Is that, and clearly fire is the big focus right now in the state. I mean, are we just on a cyclical wave here? Is it going to improve? What do you see happening in the future? I mean, do we need to wait for, some other terrible disaster to affect another part of the state so that the focus is less on, forested areas, or what does the future hold?
Tuolumne County, clearly, we have an insurance crisis going on. The market hasn't been getting any better. It's only been getting worse. We step back and we look at the state. The state's being affected as well. On almost a weekly basis now, if not a daily basis. Sometimes it seems like
Yeah.
there's another company that's pulling out, not of just out of Tuolumne County, but out of the entire state of California. The most recent one, and I had printed out an article here, was Kemper Insurance. Not a huge name, but a fairly big player in the homeowner and in auto insurance. And the title of this article here was Insurance Failing, the most disrupted personal lines environment that the CEO has ever seen from Kemper Insurance.
Oh.
And once again, we talked earlier about an insurance company. They need to make a profit, right? At the end of the day, it's not a non-for-profit business. So for every dollar that they're paying out in claims, right, they need to make sure that they're taking a dollar in on the premium side. And in this article, it goes in depth here, and they were talking about the loss ratio, which is, once again, the money that's coming in versus the money that's going out in claims. And they shared some interesting figures here, and they said that in 2022, so last year, their loss ratio, they were at 108.8%. So we round up to 109. So every dollar that they were taking in, they were paying out $1.09.
Wow.
And then in one of their other markets that they operate, they were at a loss ratio of 105.3%. So what these companies, from their perspective, is they're kind of stepping out of the marketplace and going, until we can figure out where the dust is going to settle, how we can charge rates. It's almost created this perfect storm, or this vacuum in the state of California, because we all know that when the private sector kind of steps out of things and there's no competition in the private sector, what are we left with? We're left with this insurance pool, which we refer to the California Fair Plan, which everyone says it's not fair, and they're absolutely accurate.
Well, how does California, and the fact that they're pulling out of California, where are they going? How does California compare to other states? Because we're not the only state that has catastrophic wildfires.
Right.
We're not Florida. They have flooding. They have hurricanes. The South has hurricanes. You've got tornadoes in the Midwest. We're not the only state with these types of issues.
Right.
So why is it feels like the insurance industry is so different in California?
One of the things that goes on behind the scenes with insurance companies is we have the California Department of Insurance. We have the commissioner, which is an elected position. And part of that commissioner's job is to look at rate and to approve whether an insurance company or not should be increasing rate. Prop 103, which some of us are familiar with, was passed several years back. One of the components of the Prop 103 legislation was that anytime an insurance company wants to raise their rates beyond 6.9%, so if they want to increase their rate 7% or more, they have to go through an extensive process to basically prove or show to the California Department of Insurance on why they need rate. It's interesting because it's talking to the insurance companies and going, because the question is, well, if we're having to go to the California Fair Plan, we're seeing rates go up 50, 100, the worst case is 200-300%, right? Why aren't these insurance companies on the private side be able to stay in the market and increase their rates 20-30%? Because at the end of the day, right, I think anyone would much rather pay 20 or 30% than 200%.
Interesting.
Or 100%.
Wow. So it sounds like the solution is to allow insurance companies to increase their rates more, because that would still be less than what people are faced with on the Fair Plan. But they're only able to increase 6.9% every year. What if they just did that every year, 6.9%? In 4 years, you'd have roughly,
right,
what you need. Right?
Yeah. One of the interesting things was for many years the insurance companies weren't taking rate, and rates were kind of flat. And we can probably point our fingers at some insurance companies and say, gosh, part of the blame is to lie on them because they weren't taking enough, small increment rates over the years. And then we have all this inflationary pressure, and then we have here in Tuolumne County, right? We have the brush fire that's that's impacting us. And then you have this issue of rate that was going on in the background. So what has happened is a lot of these companies have filed for these larger rates, and the insurance commissioner, it's a political position, has kind of said, no, we don't think you need that rate, to try to protect the consumer.
Oh, I see.
So then the insurance companies are saying, okay, well, if you don't want to give me my 20-30%, we're going to step out of the marketplace.
Okay.
And then once again, it's created everyone having to go to this California Fair Plan, which is not a good alternative, as we all know. Now, there's a piece in this background that I'm not sure if you know much information about or have heard. There's usually not much talk about it, but there's this reinsurance market out there.
I was going to ask you about that. Can you tell me, what is the reinsurance market?
Sure. So the reinsurance market plays a big impact on rates and what we see on the consumer side when it comes to premium. An insurance company on a catastrophic loss will insure or cover up to a certain amount. And I'm just going to use an arbitrary number. Let's say they cover up to the first $50 million of losses. Okay. So in the event of a large catastrophic fire where they're paying out hundreds of millions or getting into the billions, that insurance company is only going to take on the first, like in the figure I use, 50 million. Then beyond that, it's being taken care of by the reinsurance market. The reinsurance market is very interesting in that there's only a handful of them out there. It's a global market. A lot of it is domiciled over in Europe and in London over there. And so what they'll do is they'll back these insurance companies. So they'll back Nationwide, State Farm, Allstate, okay, after they've hit this threshold. And so what they've said is, hey, we know that there's a great potential for these catastrophic losses. So we're going to jack up our reinsurance costs, okay? Well, where does that kind of goes downhill to the insurance company that we deal with.
Interesting.
Right? And going back to Prop 103 in the legislation, the legislation specifically has language in there that says the insurance company, so, State Farm, Allstate, AAA, whoever you want to name, cannot pass along, even though they may be incurring the higher reinsurance cost, they can't pass that along to the consumer. So they have to eat that. So that too has been going on in the background, and that's also pushed them out of the market to step back.
That's interesting. So it's politics too. It's not just, it's politics and these other factors that, the end consumer is not going to be aware of at all.
Right.
That are kind of playing together to increase the overall cost. Well, overall, I mean, would you say that the amount of risk assessed to our community by the insurance industry, do you think that's accurate?
I would say that there are certain parts of our county and certain areas of our county that the risk is pretty accurate. Then there are other parts of our county where, you mentioned earlier, Tuolumne County has done a great job in securing the funds to reduce fuels in the area. Unfortunately, that's a new thing, right? It hasn't been going on for years and years. So I think we have to get ahead of the curve on that. But to answer your question, yeah, there are certain areas that are reflective of a very high risk. But what's happened and where we're kind of fighting with, and I spend sometimes hours right on the phone with underwriters trying to advocate for our clients and customers, that the space behind them is cleared. There is a fire break there. So I think there can be improvement, absolutely, right, in the brush mapping. Another big game changer too is these insurance companies are looking out, 2,000 feet and sometimes up to a mile from the property that they're insuring, whereas a couple years ago they were only looking out 100 or 200 feet.
Yeah.
So that's changed too.
What do you tell people that are struggling to pay for their insurance or to even keep their insurance? Is there anything they can do with their property to make them more attractive to private insurance?
At this point, the short answer is usually on the individual property level. Usually not. The California Fair Plan does offer some discounts if you live in a fire-wise community. So that's something you can do. I know from seeing some of the stuff in behind the scenes that's going on with the California Department of Insurance, they are trying to look at offering some additional discounts for some home hardening. I think the biggest impact that will have is to be able to allow these private insurance companies to get back into the marketplace, or for our California Department of Insurance to work with those insurance carriers, get them back in the marketplace, and then to be able to identify certain things with home hardening to get those discounts.
So, Justin, you're not a real estate agent, I know, but you do have a unique perspective on how the availability of homeowners insurance or commercial insurance, or if you're trying to open a business, how has that lack of availability of insurance affected our community's attractiveness for people to move here or people to start businesses?
Yeah, it's been affecting it in a big way, and I would say definitely not in a positive way. It's definitely had a negative impact. With that, I would say, in even current commercial clients, right? I can recently had to rewrite a commercial building in downtown Sonora on Washington Street. And part of the challenges that we were facing was that, once again, we didn't have the option to go with, several different carriers. Our market was limited for this commercial building, even though it's in downtown Sonora.
Yeah.
And with that being said, we were forced, because of some of the certain tenants that they had in the building, we really only had 2 options. And it came down to the business owner having to make a decision of, do they want to keep this specific tenant there because it was a little more risky operation that this specific insurance company wasn't comfortable with, or go with the California Fair Plan. And they actually went with the route of having to go with the California Fair Plan, so their cost went quite a bit higher.
Wow.
But they wanted to do the right thing by being able to keep that local business owner in their building.
Yeah.
So that's an example of on the commercial side. And on the real estate side, I would say on a weekly basis, we're seeing we're presenting our insurance proposal to the realtor or to the client, or that home buyer, and oftentimes if they weren't prepared for that $4,000 or $5,000 plus insurance premium, then we're seeing those escrows fall out. So unfortunately,
Really?
it is playing a negative.
Yeah. Is it something that you think people moving to the community from out of county, are they aware of the insurance issue? I know a lot of people locally are.
Yeah.
But I could see somebody trying to move up here from the valley or from somewhere else, and then just being hit with that, like you said, $4,000, $5,000, $6,000 insurance premium.
Right.
That's a pretty big hit.
It is. And I would say most if not all of our local realtors are very aware of the market and are kind of talking with those clients. But there are some clients that, if they're not represented by a realtor, or maybe have a realtor that isn't familiar with buying a house in a more rural brush area, then it can be a big shocker, and it can end that escrow real quickly, unfortunately.
Yeah. They need to get on the phone with you as early as possible to get an idea.
Give us a call at the office, or if they have a current broker, it'd be a good idea to reach out to them ahead of time.
Yeah. Well, Justin Meyer, owner of Caldwell Insurance in Tuolumne County, thank you very much for your time. Come back anytime. This has been really, really informative. I learned a lot.
All right. Thanks. Glad to be here, and glad we were able to have this discussion.
Yeah. Thank you. And thank you also for joining us. I'm Ryan Campbell. I've been your host for today. Join us again next week. We'll talk about Tuolumne County and have another interesting conversation. Take care.